So in this video, we want to solve the practical questions that will augment our understanding of the equity settled share-based payment as indicated by one of our learners, that we should make the question come as half the string and also the solutions as half the string. We are going to go by that approach so that we will ignore the link provisions at the video description. This is RONAS Academy. Do not forget to subscribe and share with others to increase our learning community. Also at least like and comment below. I think you can say thank you or just anything to show that you've commented. So if you've not watched the theories, the theoretical aspect of the equity settled share-based payment, you can readily do so that you can appreciate the practical aspects. So we will take a series of questions to understand all the principles and the concepts I have presented on the equity settled share-based payment. Now let's take the first question. The first question says that on 1st January 2018, RONAS purchased a patent. So here we are purchasing a patent. The fair value of the patent was reliably estimated to be $3. So we can estimate the fair value of the patent. So in this question, if there is fair value of the equity settled share-based payment, we are not going to use that. We are going to use the fair value of the patent, because the goods fair value can be ascertained. Then we have the consideration was transferred. The consideration transferred was 1 million of RONAS owned $1 ordinary shares. So for paying for the $3 patent, RONAS is going to issue 1 million shares, and the value of that share is $1. On the purchase date, that is the grant date, the patent had a remaining useful life of 3 years. Now the fair value of one ordinary shares of RONAS is $3 on 1st January 2018 and $3.2 on the 30th of June 2018. Look at it. So you see in this question, they have given us the fair value and then of the equity instrument and also the fair value of the assets. So I indicated that in this situation, because of the rebuttable presumption, we are going to use the fair value of the asset. Now, this is a patent which cannot be consumed immediately. And if you take into consideration very well, the fair value of the asset is more than the fair value of the equity shares. Let's do this on the board. So immediately we are going to debit asset because we are not going to consume the patent immediately. So we will debit asset, not expenses. An asset of $3 million. Then we are going to credit equity. We are going to credit equity, and the company is just issuing 1 million equity. So the excess becomes what we call premium, which is what 2, so that we can have this balance and we can have this balanced. This is as simple as that. Now you have to ask yourself, was there any condition? If you look at that question very well, there was no condition in there. So we simply say that the transaction was best. That means you recognize everything at once. It's best. There's no condition. There's no condition, so it's best. If there are conditions, that means it does not vest. We are going to recognize this equity instrument here or the equity shares here over the vesting period. That is the difference in this particular case. Now we are not done. Let me explain. Let me throw more light on this. There are some times where the goods we see, the fair value is more than the equity shares you are issuing. And sometimes the standard says that there are sometimes where we have unidentified goods included in this patent are unidentified goods. That's why the entity is issuing something lesser than the fair value of the shares. So it is left with the entity to identify or to discover the unidentified goods and then account for it using its appropriate standard. But another means of treating it is simply, crediting your share premium. Now we were told that the assets at the contract date has a useful life of 3 years, so we need to depreciate it, and they want us to show the presentation as at 30th of 06 2018. So this is not up to a year, because the contract date was 1st of January 2018. So this is going to be 6 months. 6 months. So we need to amortize, because it's an intangible asset. We don't depreciate. We don't call it depreciation. We call it what? Amortization. So let's look for our 6 months amortization value. 6 month amortization value is going to be the patent value of $3, all divided by 3 multiplied by 6/12, and this is going to give us a dollar of 0.5. So automatically this is an expense. We have consumed this aspect of what? Of the patent. So if we need to debit expenses, so we are going to debit expenses with 0.5, and then we are going to credit our assets, because it's going to reduce the value of our assets with the same 0.5. I'm using the same column, so that here we can have, this is reducing it. So at the end of the day, we are going to have 2.5, and then, but this does not affect the equity aspect. You see, this is affecting only expenses. Expenses is the asset that has reduced to 2.5. The equity does not reduce. Subsequently, the equity values does not reduce, they are not affected. Please, equities are not having redeemable period. They are not redeemed. They are assumed to be perpetual investment. The only thing is that it can be transferred from one investor to another. So they pay dividends on them. That is what the investors or the shareholders get as a return. So please, subsequently, we don't revalue this equity. It is the asset that is reduced to 2.5, not the equity instrument. Not the equity instrument. So please take it. When it comes to equity settled share-based payment, we do not subsequently measure them, in exception of when it is a performance condition that is non-market based. So that is it with this first question. Let's take our next question as on the screen. An entity has a reporting date of 31st December, okay, and on 1st January 2021, it grants 100 share options to each of its 500 employees. So the contract is that it's going to give share options of 100 to each of its 500 employees. Now, each grant is conditional. So there is a condition here. It's conditional upon the employee working for the entity until 31st December 2023. So look at this condition here. The condition is that the entity must work for the entity from 2021 to 2023. So this is what we are referring to as service condition. This is a service condition. And remember the application in the theory presentation. Remember how we are going to do with employees, the share price to use. We are going to use the share price at the grant date. So 3 years vesting period. All right. At the grant date, the fair value of each of the option is $15, as if it was indicated in the question. Now, during year 1, 20 employees leave. Look at this is the principle about the employees. And then the entity estimates that total of 20% of the 500 employees will leave during estimate. Look at the actual and estimate. Then year 2, there was 20. The actual is still 20, and the estimate is 15. And year 3, 10 actually leave. How do we account for this? That's the requirement. How do we account for this? Let's start from here. So we are looking at 2021. Okay. So in 2021, how much are we going to recognize as expense, and how much are we going to recognize as equity? So we were told that we are looking at 500 employees, and remember they said 20% of them will leave. So that means they'll be left with only 80%. Don't forget this. I've established that principle earlier, that only the expected will be taken into consideration. The actual leave will be taken into consideration at the last year when it is service condition. When it is a service condition. All right. How much share options are they being granted? Each of the employees is given 100 share options. And what's the price? The price is $15. Now we are looking at 3, but this is year 1, so we need to multiply this by 1 over 3. Once we do this, you will get the value for expenses and then the value for equity, all in dollars. So let's do that quickly. So 80% of 500 times 100 times 15. All these must be multiplied by 1 over 3, and it's giving us $200,000. So in year 1, we are going to recognize an expense of $200,000 and then an equity of 200,000. Let's go to year 2. That is 2022. And we're told that still 500, and now the expected is 15%. So this will be left with 85%. The same 100 times the same 15. All these should be multiplied by now 2 over 3. 2 over 3. So let's do that. It's going to be 0.85 times 500 times 100 times 15. So we multiply this by 2 over 3. That's giving us $425,000. Please take note of how we are going to treat this. Take note. Now this $425,000 is the total equity for year 2. Is the total equity for year 2. That is not your expenses for year 2. No. Remember, year 2 is what? An annual. The P&L takes an annual items into consideration. So we are going to less this equity from these before we can get the expenses for year 2. So year 2 expense is actually going to be 225,000 because we are taking this 200,000 from this. That is going to be your actual expenses for year 2. So take note of how expenses is treated in year 2. Don't be vigilant. Alright. Then the last year, which is 2023, now we are going to see different treatment here. Is 500 minus the actual employee that left in year 1. They said 20 from the question. Actual in year 2 was 220, and actual in year 3 is 10. This will be multiplied by 100 by 15. If you like, don't multiply anything over it because it's going to give us 1. You multiply this by 1, or 3 over 3 will give us 1. So that is it for the question. Let's do this. This is going to give us employees of 450 times 100 times 15. Multiply this by 3 over 3, which is the same thing. Like I said, it's waste of time if you are multiplying it by 3 over 3 because they still give us the same thing. That's going to give us 675,000. So how do we get expenses? We take the year 2 equity from this to get the expenses here, which is going to be 250,000. That is it for this question. That is it for this question. So you have really seen the differences over here when it is there's condition and there's no condition. Now let's look at when it is performance condition, but this performance condition is what? Market based. In our next question. Let's go. So the question on the screen. On 1st January 2021, the same year, 100 employees were given 50 share options. So here the contract is 100 employees and 50 shares. Let's look at the condition. This will vest. Look at the condition. This will vest if the employees will work for the entity on 31st December 2022, and if the share price on that date is more than $5. Look at it. The target here is share price. So automatically this becomes a performance condition, which is what? A market-based performance condition because of the share price, which is the target. So in this example, for instance, let's continue. It said on 1st January 2021, the fair value of the options was, so the ground day share price we are going to use is what? Is $1. The share price on the 31st December 2021 was $3, and it was considered unlikely that they are going to meet that target we have set for them. They were giving us information about how employees left. They said 10 employees left during the year, that's the first year, and then a further 10 are expected to leave. Look at expectation and actual. It is how we treat it under performance condition. I indicated it in our theoretical video, but we establish it here with the practical question. So look at these conditions will not be met. But I indicated that whether the condition will be met or will not be met, we still have to apply the very first contract between the entity the counterpart. So how do we do this? They said, how should the above transaction be accounted for in the books of entity in the year ended 31st December 2021? That's the first year. Right. So here we are just looking at 2021. And in 2021, they said we are giving this to 100 employees. And then they said 10 are expected to leave and 10 actually leave. Don't forget, with this, we are going to list all the expected to leave and then those that actually left. Then we multiply this by the option, which was 50. And then the price of the option is what? Is 1. The period is 2 years. So here we are having 2 periods here. So because it's a 2021, 2022. So we multiply this by 1/2. So if you do it correctly, we have our expense here, we have our equity here. So this will give us $2,000 in year 1 and then $2,000 in year 2. So it's 80 times 50 times 1, and that's 4,000. We multiply it by 1/2 to give us $2,000. So this is it with performance condition that is market-based 1. Let's take the next question, which has to do with non-market-based performance condition. Let's go. So in each of the questions, you can see clauses that will tell you that this is a service condition, this is a performance condition, which is a market-based or a non-market-based. Clauses should give you that that it should give you a guidance on as to how to identify each condition. On 1st January 2014, an entity, Blueberry, granted share options to each of its 200 employees, subject to 3-year vesting period, provided that the volumes of sales increases by a minimum of 5% per annum throughout the vesting period. On first date, with the 2014 per the question, the share option being granted is the employees in the questions are 200 employees, and they are having 3 years vesting period, but it depends on if they are able to increase the sales of the entity by a minimum of 5% over these 3 years. Let's look at how much share options is being granted to the 200 employees. They said a maximum of 300 share options per employee will vest. That means that depending on how we are able to increase the sales of the entity and how much share options will be granted to the employee. So they said, depending upon the increase in the volume of sales throughout each of the vesting periods as follows. Let's look at the condition. They said, if the sales is between 5% and 10%, then the employee will receive 100 share option. But if it is between 10 and 15, they will receive 200. If it is above 15, they will receive 15. If it's above 15, they will receive 300 share option. That's the conditions in the question. Now, the down part of the question is giving us the actual thing that happened in the question. They said, at the grant date, Blueberry estimated that the fair value of each of them option was $10. So we have given the grant date share price. That's what we are going to use. That the increase in the volume of sales each year would be between 10% and 15%. So the employees have met the condition that is 10% to 15%. That means they are going to be granted share option of 200 shares and above, because the first clause indicated it. They said if it is between 10% and the 15%, they should be given 200 share options. Now, if you look at the table below, it's giving us the specific employees that leave, those that have estimated, the further that are expected to leave, the annual sales increase, which is 14% for 2014, 15% for 20, 18% for 2015, and then 16% for 2016. Now let's look at how we do with this. How do we do with this? So the first one is 2014. Now, how many employees are we looking at in this question? We are looking at 200 employees. It was stated in the question that we are giving them 200 employees in the question. Okay. How many employees are leaving in 2018? Those that actually left from the table at the latter part is 8. And how many are expected to leave? 18. 18 are expected to leave. So we did it multiply by the sales target they are meeting. Here they are meeting a sales target of 14%, which is between 14%, the 10% and the 50%, which is 200 share of option. So they are going to get 200 share option, which is having a price of $10. All these will be multiplied by 1/3 because the vesting period in the question is what? Is 3. So we multiply this to get our expenses and our equity for year 1. So 200 minus 8 minus 18, whatever we get, we multiply by 200 times 10. Then all this might be multiplied by 1/3. And this is giving us $116,000 for expenses in year 1. And our equity too must be increased by the same amount. Then let's go to year 2, which has to do with 2015. Now 2015, 200 employees. How many that actually left in year 1? 18 actually left in year 1. You bring it here. Then 6 actually left in year 2. And then 4 are expected to leave in year 2. So we multiply this. What is the sales percentage are they getting? They are getting 60%, which is above the 15. So they are going to get a share option of what? 300 multiplied by the same value of 10. And this will be multiplied by 2/3 since we are looking at year 2. So this 200 minus this plus this will give us 18, or multiply by 300 times 10. We have to multiply this by 2/3. That's giving us $364,000. We have to take the year 1 equity from it to get our expenses for year 2. So if you do that correctly, you are going to get expenses of $248,000. Now let's look at the last one, which is 2016. Still 200 employees minus those actually left in year 1, those that actually left in year 2, which is 6. Yeah. And then those that actually left in year 2, which is 2, multiplied by the percentage. They are also getting 16%. So they are going for the 300 multiplied by 10. So here we can decide to multiply it by 3/3 or leave it because it will give us 1. So in this, we are going to get 200 minus 16, which multiplied by 300 times 10. And this is going to give us 552,000 shares. So we take away the year 2 equity to get the expenses for, which is $188,000 for the 3 expenses. So kindly take note of the treatment. Take note of the treatment. So you see how we do with the employees. This one takes into consideration the expected to leave and then actual leave. All these were provided at the table below. Okay, look at the table below. So this is going to be the impact. So in the POL for 2014, you see it as expense. In the statement of financial position for 2014, this will be an equity. So we can prepare an extract and it will be the same thing you present in there. Now let's look at our last question, which has to do with modification. So modification, the question on the screen, it said on an entity grant 100 share options to each of its 500 employees. So the share options granted here is 100, provided that they remain in service over the next 3 years. So this is the service condition. The fair value of each option is $20. During year 1, 50 employees leave. Then entity estimate that a further 60 employees will leave during years 2 and 3. Further 60 will leave during years 2 and 3. At the end of year 1, the entity reprices its share options because the share price has fallen. So look at the end of year 1, there is modification because there's going to be repricing of the share price. The other vesting conditions remain unchanged. So the 3 years remain unchanged. That means the modification here is not affecting our years, it's affecting our share price. At the date of the repricing, The fair value of each of the original share options granted before taking the repricing account was 10. So the original price was $10, but the fair value of each reprice share option becomes what? 15. So that means there is an increment of 5. Please be vigilant here. The $20 given to us at the top there is for the share option, but the price of the equity shares itself is different. And the price, the original price is 10, which has increased or repriced to 15. That means there's an increase of what? Of $5 in year 2. They said during year 2, a further 30 employees leave, and then the entity estimates that a further 30 employees will leave during the year 3. And then during year 3, a further 30 employees leave. Calculate the amount to be recognized in the statement of financial position for each of the 3 years. This modification. So we will do the original and also do the modification from the date of the modification. So let's start. Let's start. So what is the so what's the dates of the contract? So let's assume we are assuming year 1. So year 1, the original, we are looking at how many employees? We are looking at 500 employees, 500 employees, and then the actual leaving is 50, and we expect that 30 will leave in year 2 and 30 will leave in year 3. The expected must be taken into consideration because this modification. This is not just service condition alone. This modification. So to be service alone, we will not take the expectation or the expected employee that will leave into consideration in year 1. It will be only taken into the actual will be taken into consideration in year 3, and then the expected will be taken into consideration in only year 1. But here is a modification, so it will follow just as we did for the performance condition. So we are told that in year 1, during year 1, 50 employees leave this year. Yep, those that actually leave. And then the entity estimates that a further 60 employees will leave in years 2 and 3. So years 2, 60. So 60, we are splitting into years 2 and year 3. How many options are we looking at? We are looking at option of 100. And what's the price? The price is 20 of the option. So this will be multiplied by 1/3. This will give us our expenses and then our equity. So all this, they are in dollars. This is also in dollars. Okay, let's see what we are getting for the first one. So the first one is going to be 390 times 100 times 20. All this multiplied by 1/3. This is giving us $260,000. $260,000, and automatically that becomes the value for the expenses as well. That becomes the value for the expenses as well. Now let's go to year 2. It is the year 2 that there was a repricing. The year 2 was a repricing. So we will do for the original and we will do for the modification. Okay. So year 2, this is year 1, year 2. Let me bring it closer here. Year 2, then we bring it to bracket original. Original. So original will take the 500 minus the actual that left in year 150. What is the actual in year 2? During year 2, further 30 leaves. So the actual in year 2 is 30. And then the entity estimate that 30 will also leave in year 3. So 30 over here. Multiply by 100. Multiply by a dollar of 20. This will take 2/3. Then the additional, then new. So this is going to be the 500. It will be the same thing up to here. The price will change. So it will be 50 minus 30 minus 30, all multiplied by 100 times the increment of 5, because it was 10 and it increased to 15. So now this will take a different fraction. How many years is left from year 2 is 2. So this will take a fraction of 1/2. Sorry, 1/2. 1/2. So let's look at the first one. Let's look at the first one. It's going to be the same 390 times 100 times 100 times 20. All these multiplied by 2 over 3. That's giving us 520 for the equity. And then if you take the 260 from this to get the expense, you get the same 260,000 from the equity, the original. That's the original. Now let's look for the additional, which is 390 times 100 times 5. All these multiplied by 1 over 2. And this is going to give us 97,500. And this is also going to be 97,000. I believe the first one, so you don't have to do any deduction. So this is the addition. So in year 2, we are going to account for this, the summation of these two as our expense, and the summation of these two as our equity as a result of what? The modification. As a result of the modification. Alright, let's look at the year 3. Year 3. So year 3, we will look at original. So the original is, we are having 500 employees. Those that actually left in year 1 is 50. Those that actually left in year 2, they are 30. What is the actual leave in year 3? 30 again. 30 again. We multiply this by 100. Multiply this by $20. This is the original. This we can decide not to multiply because it will be 1. So if you do this correctly, it's going to be 390 times 100 times 100 times 20, and that's going to give us 780,000. 780,000, and we take the original 520 from this one, 520 from this, and I think this is also going to give us 260 as the expense for year 2. Don't forget, this one is for year 2. Then we now take the additional for year 3. Additional as a result of the modification. So remember, it's still going to be the 500 minus the 50 minus 30 minus 30. All these multiply by 100, but the price will change to 5. And this, we can also decide not to multiply by anything because this will take 2 over 2. So it's 390 times 100 times 5. And that's giving us $195,000. Now we take the year 1, the modification year 1 equity from this one to get the expenses for the year 3. So this minus 97,500, and this giving us the same 97,500. So at the end of year 2, we will treat the summation of these two, so which is 260,000 plus 97,500, which is giving us 375,000 as our expense. We are going to debit our expense with this figure, and then we will credit equity with 520,000 plus 97,500, and that's giving us $617,500. And this is what we will credit our equity with. So we are going to credit our equity with this, and then we will debit our expenses with this particular figure in the second year. If you add this to this, it will give us this one. So at the end of the day, it will balance. If you add this to this, it will give us the same figure here. It will balance. But these are yearly treatment. That's why we split them. The same thing should be done in year 3. The same thing should be done in year 3. So basically, this is equity settled share-based payment. You should try solving additional questions to augment understanding them. But with this, you should be able to face all questions that will come under equity settled share-based payment. Please do not forget to subscribe, share, and then like, and comment below so that we can also reach out to the wider community. Thank you.